Income statement shows that what all I have earned by way of revenues, whatever expenses I have incurred for attaining that revenue, and profit is what? Profit is whatever the income I have earned, the less expenses which I have incurred to attain that, and the residual value is the profit. This is one of the standardized format of or a pro forma of income statement, where we'll says that the net sales are there, other operating income is there, total income. For example, if I'm in the business of steel, so selling the steel will be my net sales. But in the process of making steel, there is also a production of say scrap or a slag. So that comes the part of the other operating income. So in order to produce steel, what all expenses I have made? For example, I have consumed raw materials like coal, iron ore. I have employed labor and employees. There are various manufacturing overheads like factory overheads, etc. We need a lot of power to do this. So these are the major headings. Then of course there would also be a selling and administration expenses like marketing of my steel, advertisement expenditures, etc., which also part of this one. So what we come after deducting these expenses would be the EBITDA, which is earning before interest, tax, depreciation and amortizations, which shows what is my profit of a company. From there we deduct depreciation and amortizations, which is a non-cash charge, which is the wear and tear of my tangible and intangible assets. Once I reduce that, then what I get is the operating profits, wherein from I have to repay the interest on the loans which have been taken, and lastly the tax. So this is nothing but profit and loss account, which indicates how the revenue is earned, how the expenses is earned, and after deducting the expenses from the revenue, what is finally flowing into the owner's pockets in the form of profits. Generally, in regular common parlance, sales or revenues is referred as top line, and profit and net earning is bottom line. Please mind here that higher revenue may not necessarily leads to higher profit. Okay. Pro forma of a balance sheet. Balance sheet in very simple terms is the statement of assets and liabilities. Say, or we can say that it shows what are the sources and applications of the fund. Sources of the funds are mainly categorized under two headings. What is the fund which has been put in by the owners of the company, which is called owners fund, which includes my capital contributions in the business in the form of equity share capital, plus whatever the retained earnings over the past years which have been reinvested in the business. The other main part would be the borrowed funds, where I have borrowed funds from say debenture holders or say banking industries or short-term loans. So these are the major sources of the funds, and how these sources of the funds is utilized in the business is the other part, which is applications of the fund. Mainly the overall the capital or the funds are either used for purchasing fixed assets like building, land, plant and machineries, etc. Or I may have invested these funds in some investments which may be related to the operations of the company, or which may be not related to operations of the company, which will be shown as current investments and non-current investments. And then a large part of my funds are also used for day-to-day operations of the business in terms of current assets, mainly inventory, debtors, work in progress, cash and bank balances, etc. And in this process, I also purchase goods funds credits, which is shown as current liabilities and provisions. There is one more thing which one should see while analyzing the balance sheet, is the contingent liabilities. Contingent liabilities are not a part in the profit and loss and balance sheet of a company. Mainly, contingent liabilities, as the name denotes, is the liabilities which are contingent on certain event. As of now, I am not liable to pay this amount, but if there is some event happens which results into an obligation on my part to pay, then it is contingent liabilities. So contingent liabilities are maybe a probable possible futures liabilities that only arise on the happening of certain event in the futures. So contingent liabilities does not affect my current balance sheet, but it should be disclosed in the notes in the form of futures potential liabilities. An example would be, say, legal disputes. I have seen almost in all balance sheet that there is a legal tax liabilities, whether it is income tax or sales tax liabilities. Say suppose the tax authorities have demanded you some payment, and you feel that this payment is not, I am not required to pay this. Okay, so you have contested in, say, legal court. So the liability of you paying to the income tax would be contingent on the court order. So as long as if the order is in your favorable, you are not required to pay. But if the order is against you, then you have to pay. Similarly, if I have given a guarantee for some company or for some other person, then I am not liable to pay as long as he is fulfilling his obligation. Only in the event he defaults, then I am liable to pay. So contingent liabilities often do not materialize into actual liabilities, but it may pose a substantial risk to have an impact on the business of the company in futures. Cash flow. Remember, my friends, higher sales does not necessarily lead to higher profit, and higher profit does not necessarily lead to the higher cash. So there may be two companies. Okay, one company is selling goods in credit and the other company is selling goods in cash. So although both of them may have earned the same profit, but the cash which is being generated by the person who is selling in cash would be higher than the person who is selling in credit. There is a saying, a bird in hands is worth more than two in bush. So the same concept applies, that whatever the profit you have earned, it has to actually flow into your pocket. Okay, that's why we have seen in many businesses that if you pay by a credit, you have to pay an X amount, say 100 rupees. But if you pay by cash, you may get a cash discount of 2 rupees. So what matters in the business is the actual amount of cash which you are earning. So how much of the profits you are able to convert it into cash is very, very important. For example, if there you have sold the goods, okay, and earned a profit of 10 rupees, it is an accounting profit. But suppose that profit, the buyer goes bankrupt or he does not pay you, so you may not receive the cash. So that's why people in the financial community looks at the deviations of the profit vis-a-vis cash very, very closely. So in cash flow statement also there are three major broad headings. One is that what is the cash which I am generating from my operations of the business. The other one would be that I am generating cash from the operations of the business, but I am utilizing this cash for further capital expansions or increasing my production capacity. So that is the cash which I am investing for the purpose of future benefits. The other one would be cash flow from financing activities, which actually shows that from where I am raising the capital or where are the sources of the funds. Say I am running a plant of say 1 million ton and I am in the process of setting up 1 more million ton plant. So for that, the amount of investments which would be required for setting 1 more million ton plant can come out from my existing profits or past profits, or for that purpose I may need to borrow the capital either from outside or from owners. So that is cash from financing activities. See, till this time we have given you a brief of what all financial statements which you look in the annual report or balance sheet of a company. Apart from this, you also have to see the notes and schedules to the accounts, which gives you a detailed breakup of individual items. For example, in other expenses, there would be many subheadings which is given in the notes and schedules to the account. So once you have seen this, you have to analyze that whether this number is good, improving, this is better or bad. So it gives you just a report card, but now you need to analyze that whether this report card is good, bad or okay. For that purpose, we use an analysis or accounting tools and techniques which we call ratio analysis. As the name defines, ratio analysis is what? Ratio analysis is the analysis of the ratio. Ratio would be what? There would be one numerator and one denominator. So, ratio is a study of relationship among various financial factors. The financial factors can be both the numerators or denominators can be from P&L account, or both of them can come from balance sheet, or one may be from balance sheet, one may be from cash flow, or there may be a number of permutations and combinations which can be done.